Simon Property Group stock, ticker symbol SPG. This stock is down 9% year to date, underperforming the overall market big time. On the 2nd of August, SPG presented quarter results where they beat on FFO and revenue. For the upcoming earnings, analysts have a mixed feeling. People love SPG stock because of multiple reasons, one of them being the dividend, and I understand why with dividend yield at 7%. So could this be the perfect moment to buy SPG stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does SPG do? Simon Property is a real estate company focusing on traditional malls and premium outlets. When we dive in the most recent earnings report, we see that net income was at a small decrease year over year. Net income per share was reported at $1.49 versus $1.51 last year. FFO was reported at $2.88 per share versus $2.91 last year. Also a small decrease, and this is something that I don't like, of course. The NOI increased 3.3%, which is a good thing. On the 6-month period, we see that the numbers are slightly different and still have an increase year over year. So that confirms the problem that is happening right now. The previous quarter is lagging behind. Occupancy rate was reported at 94.7% compared to 93.9% last year. So this increase is looking good, but I prefer at least 95% with companies like this. For the full year of 2023, they expect a small increase in FFO year over year. The estimated FFO per diluted share is expected to be in a range of $11.85 to $11.95. In here we see the numbers one more time. Revenue is increasing year over year, but again the net income is decreasing a bit year over year. That is mainly driven by the increase in expenses year over year. With the quarterly dividend being at $1.90 and the FFO at $2.88, we see that dividends are covered very well, resulting in a payout ratio of 65%, which is below the average for REITs. In here we see that the credit ratings are looking pretty decent and have a stable outlook. To me, this looks pretty good. In here we see the breakdown of the NOI and the US state breakdown. Malls and premium outlets present 71.6% of the total portfolio, and 11.5% is represented by the mills. International represents 9%. The geolocation breakdown looks very well diversified to me. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. SPG is a 35 billion market cap company. PE ratio is not a fair metric to use with REITs, so I will be using the price to FFO instead. Right now it is sitting at 10, indicating they might be undervalued. Later in this video I will show you my 3 price targets for SPG stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 5.4 billion, and in this graph we see that revenue went up in the long run. However, it still didn't fully recover from the lockdown periods. We see that margins are going up in the long run. Most recently it is coming down a bit, which is very interesting. EPS is following the same pattern, however it's a bit more steadier, I would say. Analysts expect low to mid single digit EPS growth in the coming years. Nothing too special here. For the revenue it is a pretty much the same story. It's expected to grow at low numbers in the future. Return on assets is sitting at 8.5%, which is a decent number for a REIT. Return on equity looks also really good, and the most important number, return on invested capital, is sitting at 8.4%, which is again a decent number, and is slightly higher than the 5-year average, so that's also very nice. Current ratio is at 1, which is a great number for a REIT. Nothing special here. Right now, SPG has 25 billion in debt. I prefer companies that can pay down at least a big chunk of their debt with the total cash. SPG has 837 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 7%, which is a great number. Annual payout is at $7.6 and payout ratio is at 62%, which is below the average for REITs. The 5-year growth rate is at a negative number, which is something that I don't like. But they have increased the dividends for 1 year in a row right now. In here we see the dividends paid since 2012. It is increasing at a decent amount every year, so this looks really good to me. Except of course for the lockdown periods, which makes sense to me. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at historical levels, which is very nice. Overall these dividends look really good to me, but how about the historical returns? I decided to compare SPG stock with the overall market, in this case the S&P 500. Next to that I added Kimco, REG and FRT. On the 5-year chart we see that SPG underperformed the S&P 500 big time, with a minus 17% return including dividends. The S&P 500 did beat all stocks in this list by a decent amount. On the 1-year chart it looks pretty different, with SPG sitting at a 90% return. The S&P 500 is still beating all the stocks in this list with a 20% return, but SPG is really close of beating them. On the 6-month chart it is again the S&P 500 that beats all stocks in this list. On the 1-month chart we see that all stocks and the S&P 500 are at a negative return. But again, you are better off owning the S&P 500. So bottom line, SPG underperformed the S&P 500 short term and long term. But with the stock hammered down quite a lot, it could be an interesting buying opportunity. So is this the perfect time to buy SPG stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best deals out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 0, 2 and 4%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 36, 38 and 40%. And for the free cash flow margin I'm putting in 53, 55 and 57. For the PE ratio I'm putting in 20 and for the price to free cash flow I'm putting in 14, 15 and 16. My desired annual return is 15% since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5, but I want to build in a higher margin of safety here. Right now SPG stock is at $107. I hit analyze and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $72, which is a big drop from the current stock price. We have a mid price target of $88 and we have a high price target of roughly $108. To me, the mid to high price target is the most justified here, indicating that this stock is overvalued right now. My final conclusion is that I don't like this business too much. They have a niche where they focus on, but in my opinion this specific industry is going to change a lot. And yes, people still go to malls and outlet centers, and maybe in the short term during inflations we see a little increase there, but in the long run I think they will disappear more and more. However, most fundamentals look pretty decent, besides the revenue and FFO growth, and of course the debt levels. which are both very important to me. From a dividend point of view, things look really good with a high dividend yield and also a decent track record of increasing the dividends. The lockdown periods give a diluting image in terms of consecutive years of dividend increases. From a value point of view, I don't see the excitement. It's a slow growing company that is, in my opinion, overvalued right now. So I'm skipping this stock, but I will keep analyzing them from time to time to see if things are changing. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.